This is DaniFinance. Hi, welcome to DaniFinance. Today, I want to talk about something that can truly make or break your success as an investor. Understanding your risk tolerance based on your age, and using that understanding to craft the perfect portfolio. Why is this important? Because investing is never a one-size-fits-all journey. What works for a 25-year-old just starting out is completely different from someone in their 40s or 50s planning for retirement. Without tailoring your portfolio to your personal situation, you risk either being too cautious and missing growth opportunities, or being overly aggressive and panicking during downturns. In this video, I'll walk you through why age plays such a critical role in investment decisions, how to balance risk and reward, and how to create a portfolio that evolves as you grow. I'll also share some examples and reference well-known books and research to give you the confidence to manage your investments like a pro. Let's get started. Understanding risk and age. Let's start with the basics. What is risk tolerance? Risk tolerance is your ability to withstand the ups and downs of the market. Everyone loves the idea of big returns, but not everyone can stomach seeing their portfolio drop 20% or more during a market correction. Your age is one of the biggest factors in determining how much risk you should take. The general rule is that younger investors can afford more risk because they have decades to recover from market losses. Older investors, however, prioritize preserving the wealth they've already accumulated. Let's back this up with some science. Harry Markowitz's modern portfolio theory, which earned a Nobel Prize, showed that diversification can reduce risk without sacrificing returns. For younger investors, this might mean spreading money across high-growth assets like stocks. For older investors, it could mean balancing stocks with more stable investments like bonds or ETFs. Another influential thinker, William Bernstein, highlights this in The Intelligent Asset Allocator. He stresses that younger investors should focus on growth, but as they age, they should gradually shift to lower risk assets. Why? Because the closer you are to needing your money, like for retirement, the less you can afford a sudden loss. Your financial goals and personality also play a role. Are you saving for a long-term goal like retirement? Or do you need the money in 5 years for a down payment? And how comfortable are you with market fluctuations? If a 10% drop keeps you up at night, you might learn more conservative even at a younger age. Portfolio examples by age. Now, let's put this into practice with some real-world portfolio examples tailored to your different ages and risk levels. Number 1, age 25, aggressive growth. At 25, you're likely early in your career, have decades ahead to invest, and can afford to be aggressive. A portfolio at this stage might look like this: 70% stocks. This is the growth engine of your portfolio. Stocks have historically provided the highest returns over long periods. 20% ETFs. These can provide broad market exposure and diversification, lowering your risk compared to individual stocks. 10% bonds. While small, this allocation adds a safety net for market downturns. Let's break it down further. Your stock allocation could include 50% in a global stock ETF like the Vanguard FTSE All World, giving you exposure to markets worldwide. And 20% in higher risk sectors like technology or renewable energy, which have the potential for outsized growth. Your bond allocation could go into something safe, like government bonds or investment-grade corporate bonds. However, at this age, I would stay away from bonds. Number 2, age 35, balanced growth. At 35, your priorities might start to shift. You might be thinking about buying a house, supporting a family, or planning more seriously for retirement. While growth is still important, adding more stability becomes key. Here's an example portfolio. 60% stocks. You're still prioritizing growth, but you might focus more on blue chip stocks or dividend-paying companies for steady income. 30% ETFs. A total market or balanced ETF can provide both growth and some downside protection. 10% bonds. Bonds still serve as a cushion, but you might increase this allocation if your risk tolerance is lower. For example, you could allocate 40% to an S&P 500 index fund, which includes reliable, established companies. 20% to ETFs focused on international markets or emerging economies. And the bonds could include a mix of government and municipal bonds, which are generally safer. 3. Age 45 plus, conservative growth. As you approach your 40s and 50s, stability becomes your primary focus. While you still want some growth to outpace inflation, the emphasis shifts to protecting your hard-earned wealth. A typical portfolio might look like this: 50% ETFs, balanced or conservative ETFs, like the Vanguard Balanced Index Fund, can give you exposure to both stocks and bonds. Next, 30% stocks. Focus on stable, dividend-paying companies or sectors with lower volatility. And then, 20% bonds. A larger bond allocation provides the stability you need as you get closer to retirement. At this stage, you might also start considering adding alternative assets like real estate investment funds for diversification. The role of rebalancing. No matter your age, your portfolio won't stay balanced on its own. Stocks might outperform, increasing their share of your portfolio, while bonds or ETFs might lag. That's where rebalancing comes in. For example, if you started with 70% stocks and 30% ETFs at age 25, but a market rally pushed stocks to 80%, rebalancing would mean selling some stocks and buying more ETFs or bonds to get back to your original allocation. Research from Vanguard suggests that rebalancing annually or semi-annually helps maintain your desired risk level while slightly providing better returns over time. So, what's the key takeaway? Your investment strategy should evolve as you grow. In your 20s, focus on growth and embrace risk. In your 30s, start rebalancing growth with stability. By your 40s and beyond, protect your wealth while still keeping up with inflation. Remember, investing isn't about hitting home runs, but it's actually about making consistent, informed decisions that align with your goals and risk tolerance. And it's also about patience. If you enjoyed this video, don't forget to like, subscribe, and share it with friends. Let's build wealth together, one smart decision at a time. Thanks for watching, and I'll see you in the next video.